If you're a tech investor, watch this video because the worst is yet to come. Welcome to Investing Confidential, where we are going to give you insights, hopefully, that you won't see in CNBC or any other place on the internet, in terms of discussing what's going on today in the world of finance, trying to anticipate things. And one of the things we anticipated over a week ago was this UK pension system. Everyone's talking about it now. We mentioned it, at least I mentioned it, and I knew this was going to be a disaster. Essentially because, again, I'll say it again, this is not isolated, okay? The UK pension system is like every other pension system around the world. They must match assets and liabilities. Liabilities are what the pensioners get, assets are their investments. When rates were going to zero, by the way, artificially forced down by the central banks and people like Ben Bernanke and others who are basically just theoretical maniacs, they force rates to zero because the governments don't want business cycles anymore. Well, you know what? It doesn't work, and we're seeing the effects. And if you think this is going to be a short-term situation, you're wrong. It's going to take years to wind down the mistakes, the policy mistakes by the central banks, the policy mistakes by governments around the world, not just the U.S. The EU was also definitely complicit in this ridiculous zero-rate policy, and we're seeing the results now. So, Bank of England. I'm not going to hash it out. I talked about this way before everyone's talking about it. This intervention, as I mentioned last week, the interventions don't work. At least the first few interventions. They're going to have to buy the whole bond market. Okay, they're going to have to do something very dramatic to stop it. But listen to this. The word you need to follow right now is this word called contagion. Okay, because what is happening in the UK pension fund market is going to happen everywhere else, okay? Because it's not isolated. Every pension fund around the world has the same problems. Some of them have more than others. Some of them more leveraged than others. The ones that are levered are going to have major issues because they're going to need bailouts by the governments. They're going to need bailouts by regulators, and they're going to need bailouts by their own companies. So we're seeing some fallout here in the U.S. junk market, as you can see here. You're seeing, a lot of these pension funds bought high yield bonds because they were high yield. They didn't care what was in them. Same with a lot of these funds. They're buying high yield bonds. They're buying this, they're buying that. They have no idea what they're buying. Now these bonds are being pummeled. We're going into a recession. We are in a recession. This is going to really affect. So if you want to short something, if you want to get out of something, you need to get out of high yield bonds. The spread is still too tight. It's going to get significantly wider where it should be. And this is going to be the case going forward with junk bonds. I would be out of junk bonds, U.S. junk bonds specifically, because the fallout of this pension situation is going to get worse and worse, and it's not going to be a happy ending. In the end, the pensioners will get their money, probably a little bit less than before. The governments will have to bail them out. They're going to have to print more money as usual, and that's what governments do. They print money. And they're going to bail it out. But the contagion around the world is just beginning. Just looking at what's happening, the effects of normalizing rates, the stronger dollar. You look at the returns on government bonds right now on the longer term basis. This is a disaster. Okay, if you put things in historical perspective, like you're seeing on the screen right now, this is one of the worst years in history. We're not even done yet with this carnage in the bond market. So it's just going to get worse. It's a disaster, and it's just going to get worse. We're going to see some capitulation in equities. Have we seen it yet? No. It's going to happen. It's something that always happens, but unfortunately, we're not even close to it yet. Okay, it looks like we're close, but we're not. But remember, all of these signs in terms of equity capitulation, all of these things point to rallies, okay? As I mentioned before, some of the greatest rallies come within bear markets. We're going to see markets bounce 1 day, 2 days, 1 month, 3 weeks, but in the end, you need to sell all the rallies because we are in a bear market. We're just beginning the bear market, by the way. This is a real bear market, not like the supposed bear market in 2020. That was a joke. That was a correction within at the end of a bull market, we're going to see a real bear market, and it's going to last years. Rallies need to be sold. Okay, that's the bottom line. I want to mention a couple things again that I've rehashed before. This strategic oil reserve, this depletion by the White House, this is a debacle. It's a disaster. They've tried to artificially knock down the price. They did a pretty good job, but they've depleted what is supposed to be a strategic oil reserve. Okay, they've indicated they're going to buy back, but as you can see here, I mean, this is a nightmare scenario for the United States in terms of our security, our national security, especially when you have, this whole situation in Ukraine or Russia, which could end up to be a really serious situation. And the United States, we have no oil reserves. The White House, again, trying to artificially knock down inflation they caused. Unfortunately, now we are at a very critical situation in terms of the strategic oil reserve. So that's something that really needs to be looked at. There's a lot of news today about NASDAQ finally being a bear market. Like NASDAQ is gonna go significantly lower because NASDAQ is tech heavy, and if you want to see what's coming in the tech sector in the U.S., you can look at what happened in Asia. Look at the performance of the tech companies in China listed in Hong Kong. They were one of the strongest sector to be in the world. At one point, everyone loved the Chinese tech companies. It grew, everyone's piling into them, Alibaba, et cetera, et cetera. Well, look at it now. They are breaking the COVID lows. Okay, if you look at a chart today of the NASDAQ, of the Qs, of the tech sector, no matter what you look at, we're not yet at the COVID lows. We are going to the COVID lows. Okay, again, look what happened in China to the tech sector. It's going to happen here. It's going to happen with the market, but especially the tech sector, which was overowned. Again, looking at these charts, we're going there. Okay, that's the next support level, and we're significantly higher than that today. A couple of things that are going on that could be very interesting. Again, pointing to this whole idea of recession, the yield curve. Right now, it is flashing recession. I mean, most people who understand, who follow data, and looking at other countries around the world, know that the United States is in recession. The third quarter is going to be manipulated by the Atlanta Fed. I spoke about that yesterday. This GDP now, what a joke. But the United States is in recession. And again, look at our yield curve. This is data that's been around for years, that is foolproof, and we're at it. Okay, so don't listen to anyone who tries to argue that we're not in recession. We are in recession. But there are some positive things about going in recession. There's some positive things about high interest rates. One of them is the fact that real estate and cars are going to be affordable again. Okay, look at vehicle inventory. Again, do not listen to the maniacs at the car dealerships who tell you that you need to over sticker price for a car vehicle. That's absurd. Okay, absolutely absurd. Inventories are at the highs. These car companies, they're choking on the vehicles, and there's going to be massive incentives coming. So have patience. Again, more anecdotal evidence that this whole bubble never really should have happened, and now it's popped. Same with real estate. Okay, you have all the signs are pointing to a massive bubble that is burst in the U.S. real estate market. There's no doubt about it now, and it's happening as we speak. And I just want to mention one thing that I mentioned at the beginning. This is one of the most important things that I think if you're investing in the U.S., especially the tech sector, that you've got to really worry about. As these markets become more volatile, okay, what we've seen, and I mentioned this a couple of weeks ago as one of the things that you really need to watch out for now, especially in the tech sector. Look what's happened to Peloton. Okay, Peloton, to me, again, I use this term a lot, canary in a coal mine. Okay, Peloton, you had the owner of Peloton borrowed against his shares. He was worth $1 billion at one time. Hey, everything's great. Well, this guy's wiped out. Okay, well, he's not wiped out. He's worth 30 million, but he had $1 billion at one time. And they're focusing on him, but I can tell you there were other executives, numerous executives in Peloton who did the similar things, borrowing against their shares, so they don't have to pay tax, right? That's the whole idea behind this. The large banks were very complicit on this, giving all these executive loans. They borrow, don't pay tax, they buy real estate, they buy cars, they buy crypto, buy all this stuff, and boom, stocks come down. And then when they don't have the money to pay, the brokers don't care, the banks don't care. They're just going to boom. And that's why these stocks waterfall lower. Okay. The reason the Peloton is there today is because the banks had all these loans against executive shares, and they've been banging these things out. You could look at other companies around. I'm not going to mention a lot of names. I'm only mentioning Peloton because it's out there. But let me tell you something. The entire tech sector is full of landmines. And as we go lower, and as we hit these thresholds of that these banks hold these shares, the collateral is becoming less and less. These banks are going to have no mercy, and they're just going to bang these shares lower because they don't care. They don't want to lose money. They have collateral in the form of shares. You have all these people that borrowed against their shares to live the good life, buying big houses, all this. Boom, it's going to come back to haunt everybody. And let me tell you, the problem with all this is once they sell your shares, now you have a tax liability at much higher prices. So these people who bought all these houses in the Hamptons, Nantucket, they drove the price, Miami, drove the price of real estate, buying cars, G-Wagons, all this stuff. That stuff's illiquid because soon the tax man's going to cometh and he's going to say, you owe me now $20 million, $100 million, $5 million. And these people have no liquidity. And they're going to have to sell their luxury real estate, their luxury cars at discounts. This is coming, okay? 100%. I've mentioned this before. It's coming now again. The only reason I put it up there is because I mentioned it before. You can see it now front and center. And again, Peloton is just one example of this entire thing actually just blowing up. And again, all these people that borrowed, and it's not just Elon Musk, it's not just Jeff Bezos, it's all the executives, is billions upon billions of dollars that have been borrowed against shares to not pay tax. And when these shares go down, double-edged sword, collateral's worth less, the banks have no patience, they're just going to bang this stuff out. So again, if you're holding on to tech shares, you're looking to short, be very careful of this because it's going to be company by company. And you just have to be very cognizant that if you think things can't go low, they can go significantly lower than what you might think. Finally, one last thing. I think it's time, as we're seeing indexes underperform dramatically, it's time to look at, again, I'm trying to be positive, it's time to look at small caps, okay, domestic-oriented companies here in the U.S. We have a recession coming. It's already here. Everyone's going to suffer. Even these small companies suffer. But if you're looking what to buy in the future, it's not going to be Apple. Okay, I'll tell you right now, it's not going to be these tech companies that rode this bull market to ridiculous valuations. When you're looking for bargains, because of what's happening with the dollar, you want to look at domestic-oriented companies. You want good, solid companies with very low leverage, and you're going to find those in the U.S. small cap sector. And you're going to have to be a stock picker. Forget about buying ETFs. I think if you own ETF for the next 10 years, you're going to make no return. Okay, especially with inflation the way it's going to be. And by the way, I still say inflation has come off from the highs, but it's sticky. It's going to stay high. So anyway, something to look at for the future. Obviously, some emerging markets. I'm going to do something on emerging markets coming up soon. But as always, traders, be careful out there and happy trading.